And joining us now for more perspective is Mark McCormick. He's the global head of FX strategy at TD Securities. Mark, good to see you.
Right.
Thanks for coming in. Let me get from you, because we did have this, both central bankers discuss the outlook today. And tell us what you saw in the currency markets.
Yeah, so this is clearly a bigger, broad U.S. dollar move. Dollar's weaker, U.S. data's weakening. The Make America Great Again theme that we talked about so much last year is now fading. And there's an element here where the Fed is, in my opinion, is preemptively trying to generate some insurance cuts. So what they're trying to do is they are almost, they don't have as much leeway as they did historically. You need 400 to 500 basis points on a regular rate cutting cycle to historically get them back to where they would want to go.
Okay.
Right now, they're dealing with 250 basis points. So what I think they're trying to do is extend the business cycle a little bit more. They're offering the fact that they're going to cut rates. And what they're trying to do is, I think, try to stimulate the economy to give it a little bit more support over the next 12 to 18 months.
So not unexpected, but when you take a look at the move in the U.S. dollar, more weaker perhaps than anybody would have anticipated, the Canadian dollar stronger. Why is that happening?
Well, what's happening, it's a lot of different factors. One is global growth is muddling, but it's on the verge of like major tail risk to a downside global recession. Like we are, again, as we talk about a lot, we are one more round of trade wars away from potentially pulling the global economy into recession. But right now it's muddling. So it's a good environment because volatility is low. Global growth is muddling along, but the U.S. economy is slowing generally faster than most other major economies at this point.
Okay.
If you track high-frequency data surprises, we look at economist growth revisions in terms of what they're looking at for GDP growth over the next year. On those models, the U.S. dollar is no longer a buy signal in the G9. And so what's important is that the dollar is losing that growth advantage, and the fact that the market's pricing in rate cuts means it's losing its yield and carry advantage. So it's kind of losing two big factors that were big dominant drivers of it last year. And the other side of it is U.S. equities and U.S., I would call them risk assets, are very heavily positioned for. So if you're a longer term investor and you've got a 3 to 6 month window, you're like, where is value? Where do stocks look cheap? Where do currencies have some upside where I can take some exposure? And it's not in the US. It's in pretty much every other major country.
Is it in Canada? I mean, the currency is telling us it is.
Well, I think what's interesting with Canada is, so there's an element here that the market thinks there's a little bit of a divergence between the Fed and the Bank of Canada. I will call a bluff on that because there's an element here that if the Fed does cut, the Bank of Canada has enough room not to follow them immediately. But you're not going to have such a marked divergence between the Fed and the Bank of Canada, where if the Fed cuts 3 times this year, the Bank of Canada does not do anything. What they did today was very important because they're subtly changing the narrative. They played down, and I think this is the most important thing that I saw the entire day. They played down Q2 GDP to say it's temporary. That's an important fact.
The strength that we've seen recently is temporary.
Yes.
Agreed.
That is a very, very high level point where they're like, yeah, look at upside data surprise. The economy was doing great, but yeah, we don't expect that to continue. So that's a very interesting way for the central bank to create a new narrative, because they could start to say there's a tug coming from the global economy pulling Canada lower. It's a small open economy. It's kind of a price taker in regards to the global economy. And they're not going to be able to let the Fed ease on its own indefinitely. So if the Fed eases 3 times this year, the Bank of Canada is probably going to have to cut at least once. And that kind of keeps things where they should be.
But so when you see the strength in the Canadian dollar versus the U.S. dollar today, what do you think is the right trade?
It comes back to things we talk about a lot. It is a high beta trade. Oil prices are up 3% today. S&P 500's up. Global equities are up. Australian dollar's up. Norway's up. Emerging markets are up. Canadian dollar is a part of that thematic basket.
Okay.
It's lagging Norway, which is important. The Norwegian krone's up 1%, Canadian dollar's up 0.5%. They are 2 high beta oil currencies, which mean one currency that's linked to oil is outperforming the other by nearly double today, largely because the central bank's holding it back relative to some of the other major high beta currencies.
How much of a function do you think Fed Chair Jerome Powell's comments are as relates to the U.S. dollar weakness today versus reports that perhaps President Trump is looking for ways to have a weaker U.S. dollar? That's the other report that's out there.
Yeah, these things kind of tie together. And I don't think the Fed is responding to President Trump's kind of saber rattling to cut rates. I think they're responding because global central banks are trying to coordinate a cushion in case global trade wars turn into a global recession. Also, I think a lot of them are dealing with very little ammunition, so I do think most of them are pushing on a string, and I don't think this will be effective anyway. But at the very least, they have a very fine-tuned mandate, and they want to try to manage it. And inflation is below potential in the U.S., or it's below its level. And on a symmetrical target, it's way below where it should be. So the Fed is essentially just trying to protect their mandate, and they have enough cushion to say, well, we can cut rates. And it correlates with Donald Trump telling them that they should cut rates. But they're doing it largely, I think, because they're concerned if they don't ease now and things make a turn for the worse, monetary policy won't be there to rescue the economy.
So what's your take then in terms of what the market should be expecting? How many rate cuts should the market be expecting this year then?
I would say two. Two is reasonable. Three means that something has gone a little bit afar. Again, China, what we're seeing there is one of the best leading indicators you have in China is the credit impulse numbers. They are stabilizing. They're not accelerating. But some of your leading indicators, again, are showing, again, a muddling global economy. We're not seeing one that's decelerating further, but it's not accelerating. So in this environment, you probably get two Fed cuts, one in July, maybe a follow-up in September. And you have the Bank of Canada on hold at that point. So you have this divergence play out, but it doesn't do a whole lot for the currency because it's already been priced in. But this is an environment where Fed is easing. Equity markets in the U.S. are well positioned for. Equity markets outside.
For what? For a rally?
So what I'd say the market is well positioned to be long U.S. equities.
Okay.
So there's more room to be long currency or equities outside the U.S. So as an asset allocation framework, like the things that we look at in terms of positioning, we're looking at 100% of our signals are saying that markets are long U.S. equities. Half of those signals are long Japanese or European equities.
Okay.
And
no, I was going to say, what about the Canadian market? I mentioned at the top of the show that we did see some increased volumes in the XIU yesterday. It feels as though there's a bit of a buy Canada trade on. I wonder as well when we take a look at the Canadian dollar if that's not part of that.
Yep.
What do you think?
I think it's part of it, especially because energy is doing really well. You know, your major baskets for a Canadian index is banks and energy. So, you know, you have a big day in oil moves. You have a weak U.S. dollar. You got kind of a global reflation theme for the day. Commodity prices are higher. That benefits the Canadian equity indices. So there's an element there where that's kind of the pass-through. It's not great for financials, largely because you had talked about kind of the impact it has on yield curves. But there's enough strength in the energy sector and a weaker U.S. dollar that's kind of reflating all those things that connect to that theme.
Mark, bottom line for our viewers at home, what do you think is the right takeaway from the Bank of Canada today?
The most important thing, I'll say it again, is the fact that they downgraded their view of growth. They called it temporary. That's very important, meaning like it's not going to happen again. We're not expecting Q3 and Q4 GDP to look as good as it did. And it's a very easy way to start to pivot the narrative. If they need to cut rates, they're not cutting rates because the economy's weak. They're cutting rates because of the tug that's coming from the global economy. And I would argue they're cutting because the Fed's cutting.
Okay.
So the most important thing to me is they are pouring cold water and they are downgrading the strength of the economy that people have talked about a lot in Q2, which is why I'm not overly optimistic on the currency. Like we nudge our ranges a little bit higher for the Canadian dollar, but none of what we've seen the last couple of months is a game changer.
Okay, and pricing then for the Canadian dollar for this year?
I would say we peak at 78 cents.
Okay.
That would be the level. I think you probably stop short a little bit above that, but that requires 2 cuts, maybe 3 cuts from the Fed, and then at some point the whole thing will recouple, because if we get 3 cuts from the Fed, then the Bank of Canada is going to go. So we'll have to reprice the rate curve. But if the Fed cuts 2 or 3 times, again, that'll be reflationary for the global economy. Oil prices would be higher, equity prices outside, U.S. and outside of the U.S., but U.S. equities would probably underperform. And that's just a good environment where it's a weaker U.S. dollar, it's a stronger rest of the world, and Canadian dollar generates the beta to that type of market environment. So that, you know, again, it would be probably about 78 cents until it probably started to move lower again.
Okay, Mark, we got to leave it there. Great to see you. Thank you very much
For having me.
That is Mark McCormick. He's the global head of FX strategy at TD Securities.